Good afternoon and happy spring equinox, everyone. Welcome into the latest edition of the KLG webinar series. I'm sure most of you, especially those of us who live in the Northeast, are keen to leave the short, cold days of winter behind us as we turn our attentions towards the spring and a time of growth. So in celebration of the first day of spring and the tip-off of the NCAA tournament, we are delighted to present to you this important, informative program, Reviewing Corporate Partner and Partnership Tax Returns, a guide to key information, presented by KLG partners Lou Panariello and David Gralnick. My name is Steve Cusimano, and I'll be the moderator of today's discussion. This presentation is ideal for any practitioner whose clients are business owners and want to learn more about where to discover the elements of income, cash flow, and assets connected to the business. And as you'll see, Lou and David do a great job of covering this topic. And if there are any questions throughout the presentation, please submit them through the Q&A section of the Zoom window, and I will present the question to the presenters at a natural break. One note before we get started, on Friday, April 17th, that's 4 weeks from now, Lou will be back on the webinar scene, this time with KLG's Rich Bilott to cover the topic that everyone wants to learn about in April, that's reviewing personal tax returns. 2 days after the filing deadline, so it's just as timely a program as this one. We'll be happy to include a registration link for the April webinar, as well as the slides from today's webinar and a link to watch the recording of this webinar in our email to all of you following today's session. So without delay, it's time to introduce today's presenters, partners at KLG, and the anchors of our discussion, Mr. Louis Panariello and Mr. David Gralnick. Louis F. Panariello, CPA, ABV, CFF, as we casually call him around these parts, brings to the table nearly 2 decades of experience guiding closely held companies and legal professionals through complex business valuations, forensic accounting matters, and high-stakes litigation. Widely recognized for his expertise, including court appointments as a neutral financial expert, Lou has testified in numerous cases and provides trusted insight on everything from matrimonial disputes and shareholder actions to asset tracing and corporate planning. David Gralnick, CPA, ABV, again, just what we call him casually in the office, brings a powerful combination of business valuation expertise, investigative accounting skills, and deep tax and litigation experience, having advised hundreds of closely held companies and professional firms. He's known for his sharp analytical approach and his broad background in consulting, auditing, and forensics, and he has nearly 30 years of experience in the field. David delivers clear, reliable insights in even the most complex financial disputes. And today, they're bringing their skills and experience to the KLG webinar stage to present you with Reviewing Corporate and Partnership Tax Returns, a guide to key information. So without any further ado, I give you Lou and David.
Thank you, Steve. We're just going to put our little disclaimer up for a minute so you can quickly read that we're not giving advice here. We're just teaching you guys and giving you key points on how to do it. Yes, it is 2026, so the bottom should read that. Okay, so we're going to start with just a brief overview of tax returns of both corporate, S corporation really, and we'll talk about the differences on those, but really between corporations and partnership tax returns. So corporate tax returns, there are 2 types. There's the S corporation, which is Form 1120-S. That's your pass-through entity where you receive a Schedule K-1 and you pay the taxes on any income on the personal level. We also have a C corporation, which is just Form 1120, and the difference really between the S corp and the C corp is the C corp pays taxes itself, not on an individual level, so there's no K-1. And then there's the partnership tax return Form 1065, whereby it's basically the same as a corporation's tax return. You get a K-1, it's passed through, it's filed, the taxes are paid through the personal tax return. However, it's just a different form and a different structure, as you all know. Moving on. So why is it important that we know, about business tax returns? So for purposes of attorneys, number one, in litigation, you want to find out who has the true control of the company and who has the true and what the true earnings are. So what the actual business returns show, how the income is generated, how the cash flow is. We can use that for support. We want to look at distributions and lifestyle analysis sometimes for distributions, and who has control over the company and who can make the decisions. Number two, taxable income versus cash flow, which we kind of just briefly talked about. The pass-through entities can report shareholder income, but those don't include distributions. So that would be your income. Your distribution would be the cash flow portion of it. Obviously, there are other expenses such as depreciation, which may reduce reported income, not reducing cash. Other things like personal expenses, those could be on the tax return. Those would go into both the taxable income and the cash flow. And then forensics, consistency in identifying red flags. So we look at year-over-year comparisons to indicate if there might be an issue with more recent tax returns for purposes of divorce planning or some kind of planning thereof. So you're going to want to look at the trendings of them to see if there's any major differences.
And when Dave references major differences, um, very specifically, we look at, the revenue of the company year over year leading up to the matrimonial action if it's for a divorce case. And we look to see if there's a downturn in the revenue, which, like Dave said, it could be for divorce planning, or if we do some industry analytics, perhaps it's something that's attributable to the industry, or even further to, more of a macroeconomic issue. But the only way to get to the heart of those issues is, like Dave said, is to look at not 1 year of tax return, but multiple years of tax returns. So I sort of just mentioned the revenue, but I'm sure we can all agree that owners of privately held entities, they always report their expenses fairly and accurately, right? No,
All the time, Lou.
of course not. I would say, I can probably count on one hand the number of cases I've worked on where there wasn't some sort of adjustment that needed to be made to the reported figures on somebody's business tax return. And that's because as a privately held business owner, you have that discretion to deduct expenses in the manner in which your risk appetite serves. Having said that, when we do open up a tax return, there are some specific expense and cost of goods sold categories that we seem to find stand out a little bit more than others. And we're going to get into a really good example on a real tax return in a little bit. But first and foremost, the purchases category on a business tax return, it's typically a very large number, right? And that's because businesses that have cost of goods sold are typically operating with 50, 60, 70% of their revenue going into this cost of goods sold, which is purchases of material and things of that nature. That in and of itself, being a large number, is an easy place to hide personal expenses and payments for personal expenses. So, that's one area that we look to immediately. Repairs and maintenance. We tend to find in that category, there could be repairs and maintenance and renovations to someone's personal home that gets expensed through the business. It's very easy to mask payments to contractors and things of that nature, as legitimate business. So
Especially
that,
if you're in construction.
especially if you're in construction, exactly. Advertising, again, that's just another category, that we see a lot of expenses get allocated to. Then you have sort of these real in between discretionary type things. So the first one is travel, meals, and entertainment, right? So there's always the argument, I'm taking clients out to, for business meals, and that is, of course, legitimate. But when you're looking through a general ledger and you're trying to understand the expenses that are on the business tax return, sometimes just seeing a list of restaurants isn't so apparent. So there's a little bit more digging that has to be done. But just because of the nature of, the reporting, it's restaurant names, hotel names, it's very easy to, expense those on a business tax return under the guise of legitimate business expense and legitimate business travel. So that's another category. And then the very last category that I said is sort of an in between, auto expenses and cell phone expenses. So everybody's on their cell phone these days. Everyone has their email that goes to their cell phones, right? So that's become a pretty legitimate expense of the business. But we do look to see if there's, family plans that are being deducted on the business expense beyond just the business owner's particular line. So that's important. And then auto expense, of course, traveling around for business certainly warrants, a certain level of auto expense, but we look at the reasonableness of that expense. If we're valuing, a consulting business and the person has to travel for business, but they're writing off a $2,000 a month Porsche in order to do so, that might not be considered legitimate, but some level of auto expense is legitimate, right? Um,
Well, on top of that, people say, I'm using my auto for work, but they go to and from an office, and that's all they do. That's legitimately not a real auto expense. So those are things we look at as well.
right. In the IRS's eyes, it has to be not from home to office, but from office to some other destination.
By the way,
Um,
that's a little fuzzy now because now you can actually go up to your home office, work there for 10 minutes, then go to your second office, and then it's a legitimate IRS business expense. Just a little tip.
there you go. And the second thing to highlight, Dave mentioned earlier, the difference between cash flow and income, and a good way to sort of not necessarily manipulate, but sort of alter the reported cash flow on a business is certainly through depreciation expense. That's very apparent when you're looking at very heavy asset intensive businesses, right? So a real estate holding entity is going to depreciate a building over 30 years. And every year, even though it's not a real cash outlay, that business owner's cash flow is going to look like it's something less than what it really is because they're taking, a depreciation expense year over year. Very similar for a construction company that has some heavy equipment, heavy machinery. They have the ability to write that off over a number of years, but also they have the ability to write that off just in the year it was purchased, which is what's called a Section 179 expense. And that becomes very relevant when if you're, in the matrimonial space and you're looking at the most recent tax return and some equipment was purchased, all of it was depreciated right up front. And as a result, that business owner's cash flow could look like it is significantly suppressed from prior years. The key is to, sort of analyze what that business is going to generate going forward. And it's not going to be buying heavy machinery year over year. That's the analytics that we do once we, really bore into the numbers. But that is the way that from a tax perspective, somebody could lower their income on paper.
In addition, based on the new OBBA, there's additional bonus depreciations that can be taken. The limits have been increased. They'll be increased into the future for inflation. So just keep that in mind as well. Those limits are higher, so you may see more and more of that stuff.
So the next part of a tax return that's pretty important is the balance sheet. And the first thing that we look at when we're opening up a balance sheet is the cash balance. And it's not just the cash balance as of the most recent year that we receive. It's what's the trend in that cash balance, right? Has the cash balance, been building up over years? And if that is the case, we need to understand why. Now, sometimes companies have an expectation of significant growth into the future. So it's a legitimate expectation that they'll need cash on the balance sheet in order to fund inflated expenses going forward. But sometimes we also see the other side of the coin where, there's some, divorce planning that goes on and, spouse A thinks that if they just hoard all of the money within the business that, it's gonna, sort of fly under the radar and that cash buildup will be theirs to keep going into the future. So, we analyze that and we always let, the attorneys know, hey, this business needs $100,000 on its balance sheet in order to fund its operations. But because profits haven't been distributed in the last 2 years, it actually has $250,000 on the balance sheet. That $150,000 delta could easily be in a marital bank account, subject to some, a different type of distribution, if you will. Um, Another item that we look at on the balance sheet, we mentioned earlier depreciation on, large fixed assets. But when you're talking about, buildings and things of that nature, those may require, an appraisal in order to understand the fair market value of those assets. So we like to understand that very early on in the case so that we can advise if, these appraisals need to be done. But secondarily, other than depreciable assets, we also look at ownership in other entities or investments in other pass-through entities, which would require more discovery to understand the ownership nature and exactly what that pass-through entity does. And then other items that we look at on the balance sheet, we're going to get into a specific example in a little bit, is debt. And when I say debt, I mean interest-bearing, legitimate third-party debt. And we, obtain debt statements in order to verify that that is bona fide debt on the balance sheet. And then we also analyze shareholder loans, which is very common for, a business owner to either loan money to the company or be loaned from the company. And in the context of a matrimonial case, we typically go to the statement of net worth if you're in New York, or financial affidavit if you're joining us from Connecticut. And we look to see if that business owner has reported the other side of those loans, if it's a asset of the company, if they're reporting it as personal debt on their own, disclosure for their matrimonial purpose. So that is another item that we look at. And Dave will talk to you about K1s.
Okay, so K1s, this is where you can look to really find out what the individual owner's income and cash flow is. So the first thing you're going to want to know is their ownership. They own 100%, 50%, something else. In an S Corp, all of those are the same. So you have the profit, the loss, the capital. Those are three different elements. The share on an S Corp, you don't even see those elements. It's all one percentage. So if you own 50% of the company, you get 50% of the profit, 50% of the losses, 50% of the capital, and any distributions are going to be 50%. If you have a 1065, profit, loss, and capital can all be different. We're going to show that later on a K1. Not only that, you can have uneven distributions. So those are things you're going to want to look at. If you see somebody got $1 million, they own 50%, and the owner who owns the other 50% got $100,000, you're going to want to find out why there was a different distribution. So ownership is the first thing you're going to want to learn. You're going to look at the ordinary income, or if it's a real estate, the rental income. What kind of income is there? How much is it? The distributions will be shown on the K1. We're going to show you other places where the K1s are. And then on a 1065, there's also something called a guaranteed payment. It's basically in lieu of a W-2. You receive a guaranteed payment because in a partnership, 1065, you're really not supposed to get a W-2 if you're an owner. We see it happen. It is what it is. But it's called a guaranteed payment, and you look on the K1, it'll show you those numbers, and we'll go through that with you shortly. Lou, you're on mute.
Yep. So let's open up. So this is let me end that slideshow. Okay. You guys see the tax return? Just want to make sure we're good. Excellent.
Yes, sir.
Okay. So this is a Form 1120S. As Dave mentioned earlier, this is for purposes of reporting for an S corporation. So a few things of importance that are right on page 1 of the tax return and right at the top of page 1. So the first part is, what year does this particular tax return report? And when I say what year, I'm looking at what is the end of the year. Now, you can see that this particular tax return, they left this particular part blank. And the reason for that is because this particular tax return is reporting on a calendar year. Had this tax return gone through March 31st of 2025, then it would explicitly say so right in this section here. Okay. Just below the tax year is the actual name and address of the corporation. So that's pretty straightforward. Over on the right, in box E, we have the date that the business was incorporated. Now, this doesn't always agree to, some of the, agreements that we get, the documents that we get, because it's strictly when the company was incorporated. This business could have existed, prior as, some other form, an LLC or something. It doesn't necessarily have to have been in the form of this S corporation. So this is specifically when this legal entity was incorporated. Over on the left, we have the business activity number. So this is synonymous with what's called a NAICS code, North American Identification Classification System, which is the government's way of taking data from tax returns and stratifying it by industry. Okay, so essentially, when our government is collecting statistics, and it's going by industry, it's going to use this code. For us, it's a good way to go into the NAICS database, pop in this code, and see what industry this tax return purports to operate within. Our experience could tell you that this particular number is not always accurate. The accountants their feet are not held to the fire on whether or not this is an accurate number. It is more or less for compiling data. Just below the next section on the first page, what I like to point out is this little section right here, and particularly whether or not this is a final return. So box 1 will be checked off if it is. And also if it's an amended return. If it's an amended return, you'll want to understand what the amendments were and why it had to be amended. If there was an audit of sorts, that's sort of the tipping point for that. The next section I lets you know how many shareholders exist within this business. So this one is fairly straightforward. There's only one shareholder, but if there were 2 or 3 or 4 shareholders, that would be indicated right on page 1 here. Okay, moving down into the numbers. The next section of page 1 is going to let us know what the income is of the business. Now, it says income, but in theory, it's really revenue and other income less cost of goods sold, and that's all here in lines 1 through 6. As you can see, there are many expense items that we'll get into that are taken before. So just sort of the nomenclature of total income loss on line 6. Don't take that to be the total bottom line income of the business. But what this section reports is, number 1, it reports the gross receipts or the sales of the business. Why is this important? This would be the very top of the entire calculation in determining the net income of the business. If the revenue is wrong, the income is wrong. So the very first part of our valuation analysis is always to make sure that the reported revenue is accurate and inclusive of cash and things of that nature. So in this case, this business reported $1.5 million of revenue. To the extent that there's extraneous revenue in the form of cash, that would be additive to this and would alter the resulting income at the bottom of the tax return. The next line item is for cost of goods sold. This is what we talked about earlier with that purchases category. So as you can see right off the bat, the cost of goods sold on this business is $1 million. So they made $1.5 million in gross receipts, but they take $1 million right off the top of that for cost of goods sold. And Dave's going to get into the subschedule for that. That's a few pages into the tax return that details out that $1 million.
And just be aware, not all entities have cost of goods sold. Obviously, law firms, accounting firms, and any of those for sure aren't going to have cost of goods sold. But there are many that do, many others that do not as well. So if you don't see it, that's not something abnormal.
Correct. Okay, so the result of those two items is to calculate the gross profit of the business. This particular business does not have any other income, but to the extent that it was receiving income from pass-through entities, or if it had a large balance of cash in the bank and there was some interest income, that would all get reported on this line. So the next section of page 1 is going to be all of the expense items, or as the tax return denotes it as deductions. So the very first deduction right at the top is compensation of officers. So as we kind of mentioned earlier, this particular tax return only has one shareholder. So that this entire $36,000 that you see is for one shareholder. However, for instances where there are multiple shareholders and you need to know how this compensation of officers breaks down, there is a subschedule that reports that breakdown, and that is going to be in a few pages as well, so that you can see that. The next line item, so this is typically after the purchases category. Typically, the next largest expense item that we see on a tax return is salaries and wages. So in this case, it's $100,000. Now, this particular line item is it's less concerning to us because we'll request W-2s that reconcile to what's reported in this salaries and wages expense, and that'll sort of help put that one to rest. As long as the W-2s reconcile with this expense and we know who's being paid, and as long as it's not family members and people that aren't actually working in the business, then we're all good. The next batch of expenses are all typical operating expenses like rent, taxes. We talked about depreciation earlier, where we look to see what the actual cash expenditure is in a particular year, because depreciation is just a tax adjustment, to write off whatever was purchased in prior years. Advertising, we mentioned earlier that that's usually another large expense on the tax return. So we look into the details of that. And then we'll show you in a little bit. You see this line 20, other deductions, for $193,000, another big number relative to this company's revenue. And you see it says here statement 1. So this particular 193,000 is going to be detailed out on statement 1, which are the federal statements attached to the tax return that go in the back of the tax return. So what you can do is flip through all the pages, get yourself to statement 1, and you'll find all the detail for the $193,000, and we'll show you that also in a few pages. The end result of all, okay, Dave.
Sorry, I just wanted to add something on taxes and licenses. Sometimes you'll see a statement on this, but if that number is considerably higher, or higher than this, or even this, it could include some pass-through entity tax that's paid on the personal level. So essentially what the pass-through entity tax is, it's a way of paying your personal taxes and lowering your personal state taxes through the company. So if you pay $20,000, for instance, or $10,000, which would make sense in this case, $10,000 could be an add back, because you're taking $10,000 just to reduce your essentially it reduces the business income, but then it's going to pay your personal taxes essentially on that pass-through income. So when you see tax and licenses, we've seen it hundreds of thousands of dollars, and there's not a lot of salaries and wages. Sometimes it might, includes PTET, just something else that you might want to look out for.
Okay. So the end result of page one, we've only gone through page one of the 1120S, is that you can actually see what the person is at least reporting as income. So in this particular case, this business owner reported $36,400 of officer's compensation, and they also reported $77,000 of pass-through income. So effectively, without making a single adjustment, without looking at the $1 million of purchases yet and determining if there's any personal expenses in there, without considering any unreported cash income of the business. On the very surface, what's reported here is $113,000 of income. And that's our baseline that will then be adjusted based on the remainder of our analysis. The second page of the tax return gives you some qualitative data about the business. So the first thing it gives you is the accounting method. We do a whole webinar on income versus cash flow that dovetails into cash versus accrual, and what the differences are there. But it is important to understand the accounting method upon which this tax return is reported. So in this instance, it's the cash basis. So revenue is going to be reported when actually received. Expenses are going to be reported when actually paid, regardless of the period for which, that either the work was done or if it's an expense, what that expense covers. If they pay a 2-year insurance policy in this year, the total expense is taken in this year. But under accrual basis, that 2-year insurance policy will be written off over those 2 years for whenever the economic benefit of that insurance payment is actually realized. So that's in sum and substance the cash versus accrual conversation. But the way to understand what you're looking at with this tax return is on page 2, right at the top. The second part here is it sort of dovetails into that NAICS code that I mentioned on page 1. This gives it a little bit more explanation. So here we're dealing with an auto repair business, essentially. The next part of page 2 that's important is section 4, which is broken up into 2 sections. But what section 4 seeks to report is if this entity has an interest, direct or indirect, in another entity, and that would get reported on the balance sheet. But this is looking specifically for if that interest is 20% or more. So if for whatever reason this auto repair business decided to make an investment in a private equity company and it owns 0.002% of some startup company, there's no need to report it in section 4 right here. But that investment would be on the balance sheet. And that's the most important stuff on page 2. So looking to page 3 of the tax return. So I'm going to direct you to Schedule K. So Dave's going to go into the Schedule K1s in a few pages. Each K1, the nomenclature is important. The K1 is for each individual shareholder on an S Corp, and it's for each individual member on an LLC or a partnership. All of those K1s are reporting that particular shareholder or member's pro rata share of the net income, the distributions, so on and so forth. So what you need to do first, before you get to the K1, is first determine that information for the entire company. So in this instance, Schedule K is saying for the entire business, the whole business made $77,000 in net income. If there were two 50-50 owners, each of those owners would report their 50% of this $77,000 number. Now, this is owned by one person, so that 77,000 is only going to one K1, and we'll get into that in a little bit. Looking further down, another important item to pick out of this particular page is section 16 and item D. So what this is telling us is the reported income may have been $77,000, but we want to know cash flow, right? That's what's the most important. In this particular instance, this shareholder of the $77,000 in net income, they distributed $75,000 to themselves, and they left the other $2,000 in the business. And there's reasons for that. It's not usually always a nefarious thing. $2,000 isn't a lot of money. And Dave?
Okay. Well, $2,000 may not be a lot of money to Lou, but some of the others of us, you know.
Relatively speaking.
Just throwing it out there. Anyway, so this is your Schedule L. It's the balance sheet. This is not always filled out. There are certain limitations from the IRS that indicate if you even have to fill it out. However, if it is filled out, this is important. So obviously line one, you have the beginning of the year and the end of the year, right? Okay. We start with the assets, and line one is cash. And, you know, we've kind of talked about cash. So on this tax return, not a lot of cash, but if you see that, you know, for instance, if the cash went from $2,897 to $100,000, you start to ask questions. Why do they need so much cash all of a sudden? What happened? Why didn't they distribute it? All those questions. Inventory, not all entities have inventory, but again, it shows the beginning on the left, and on the right, it shows the end of the year. Buildings and depreciable assets, we talked about that earlier. That's going to be your fixed assets or your equipment. There might be a car on it. We're going to, you know, there are, hopefully, I know in this case, I don't think there is, but we always ask for the fixed asset schedule. So that's something that, you know, if you do not see it, you want to probably request, because you're going to want to see what kind of assets there are, how old those assets are, because they may have a lot of value. And then other assets, this is going to be something on your schedule. So the total assets on the left at the beginning of the year, on the right, the end of the year range, they're fairly close, 497, 516. So now we go below. And the big thing is obviously this mortgage payable or note payable. So we're going to want to find out what that is. Obviously, it's a very large number in relation to the assets. It's almost 90% of it. So we're going to want to know what that is, why they have this, what does it represent? It's obviously not all for fixed assets. It went up some this year. Why did it go up? All those questions are going to want to be asked. And then at the end of the day, when you look at the bottom, from lines 22 through 26, those are going to be what the equity of the company is, or, you know, the net asset value on a cost basis, or cost less depreciation, because here there's depreciable assets. So you're talking somewhere about $41,000 to $43,000. That's basically the, you know, the minimum value, because unless there's some kind of loans or something, shareholder loans or other things that you'd have to take into account. So moving on to the next page, we're going to have the Schedule M1 and Schedule M2. And what are those? Schedule M1 reconciles the books of the income of the books to the income of the tax return. And Schedule 2, basically, it goes through and shows you exactly from the beginning of the year to the end of the year what happened to the equity of the entity. Okay, so we'll start with M1. Always start with the book income, $76,000. Now, the only thing here that's an adjustment is travel and entertainment of $201. Okay, so as most of you know, there are sometimes limitations on the entertainment and meals and travel you can take. So they've taken that. But other things we see here, depreciation, officers' life insurance, that's a key one you want to keep aware of. Those are, you know, other things we see on the M1 that we always kind of like to look at. Depreciation, there are differences between book and tax sometimes, so that you want to, if you see that, you're going to want to understand that a little further. The Schedule M2 basically starts with last year's equity, okay, which is the 28,752 plus the 12,500 in the other adjustments account. Don't ask why there's another adjustments account. It really doesn't have much impact on anything you're really going to have to worry about. You add the ordinary income, any other additions, and then basically you take the losses or the reductions. You're going to get to what the equity is. Then you take out the distributions. In this case, it's 75,000. And the balance at the end of the year is back to that basically $43,000 number, which is the balance at the end of the year plus the accumulated adjustments of $12,500. So you would have to add those two to know the equity, and that's what should match what's on Schedule L, 42,877. Okay. Moving on, we talked about Lou talked about this briefly. This is your cost of goods sold section. It's 1125A. Basically, what this does is just show you what the makeup of the cost of goods sold is and how they account for it. Okay, so you start with the opening inventory, you add purchases, the other costs, you'll see the cost of labor a lot up there, but other costs, we'll see what those are here later on when we look at the statements briefly. Then you have the total, and you'd then subtract the ending inventory to get what the cost of the goods sold during the year are. And why is that important? Because if you want to see if gross profit of the company changes percentage-wise each year by a fairly large amount, if it changes by 1 or 2%, nothing to really worry about, most likely. But if it changes by 7, 10, 15%, and we see it often, you're going to want to know why. What happened? Why do you have all these purchases? Why did the cost of goods sold go up? Was it the price of oil? Was it the price of stuff that you just didn't pass along to customers? All things you're going to want to consider. And then if you look at 9, it basically tells you the method used. So the cost approach, fairly obvious. It's what the cost of what you purchased is. The lower of cost of market, which is what we're going to see most often, as either, as it says, the lower of the cost or the lower of what that inventory is actually worth today. So if you have, inventory that's 15 years old and you can't sell it as a zero value, therefore you're going to account for that, and you're going to have, it would lower your inventory, and therefore it would change the cost of the goods sold. And then there's other ones we don't really have to get into. And essentially that's going to be what your 1125A is. So that's your cost of goods sold section. Moving on, 1125E is a big one because it's the compensation of officers. It tells you exactly who the officer is, what percentage of time they devote to the business, what percentage of stock they own, and what their compensation is. In this case, although are there multiple K1s here, Lou? I think there are, right?
No, that's
No,
on
there's
the
one
partnership
K1.
we have.
Apologize. There's one K1 here. They own 100%. They get all the compensation. They're going to get all the income. And therefore their compensation is 36.4. If we have multiple people, it's going to show, if there's compensation to them, it would show multiple. If there's no compensation to them, very most likely not going to be on this schedule. So, and again, you can see you only have to, it is the little note up top, if receipts are 500,000 or more. So if it's a small company with $300,000 or more, they're not going to have this schedule necessarily. Lou, I think you're up again.
You were taking this.
I apologize. I'm taking this too. So this is your schedule K1 on the S Corp. Up top, it would show you if it's final or amended. It's going to give you the corporation name. If you look at D, corporation's total number of shares, 200 beginning, 200 end. Going down, it's going to give you the shareholder's name. Lou, if you could keep going down a little so we could show yeah, thank you. It tells you what type of entity this is. Is it a person? Is it another corporation? What percentage of the business they own? And you can see the shareholder has 200 shares at the beginning and 200 shares at the end, which is good because the corporation has 200 shares at the beginning and end, and they have 100%. If you see something weird like, current year allocation is 100%, but at the end of the year, there's 400 shares in the company, they only have 200 shares, obviously you're gonna have to start asking questions. And then if you go back up, Lou, so we could go through the points on the income. If you look at one, ordinary business income, 77,000. It gives you if there's going to be dividends, interest, or capital gains from 4 through 8, or 9, really, section 1231. If there's going to be any other income, it would go in line 10. Lou, if you could move down a little, please. Thank you. The other deductions is probably going to be something that's not, that you don't get credit for. I don't even know what A is on this one. And then the most important one there is 16D. That's the distributions. That should tie out to what's on the Schedule K, at least their percentage of it. So in this case, since they own 100%, we know the Schedule K showed 75,000. We know the M2 showed 75,000. So everything reconciles, which is always a good thing. That's what we want to see.
David,
Unfortunately, there are plenty of times where they don't.
Sorry about that. Before you move on, I just have a quick question. What would be like one of the reasons for the current year allocation percentage not to match the number of shares that the particular owner has based on the number of shares that are outstanding?
The accountant screwed up.
Okay.
That's really basically the only reason. But you're gonna it could have been that in the past there was 400 shares, and they just didn't change it for some reason, because there could have been, if you go back to Lou, if you want to go back to Schedule L for a second, which is the balance sheet towards the bottom, there's this cost of treasury stock that might indicate some kind of buyback, or maybe they purchased shares from another person. So there were 400 in the past, and the accountant just didn't change it because now that they own, there's 400 total shares still, and they own 200 in the past, plus the 200 they bought. Those are reasons, like an accountant, it's an accountant screw up, but there might be reasons for it, which is why I said you might want to look at it.
Thank you.
No problem. And these are the statements that we talked about earlier, the other deductions. So, the auto and truck obviously we always look at. The total lose highlighting the 193, 190. That's what goes to the first page. Other things, insurance, we often see personal insurances. Meals, not a big number here. Legal and professional fees, not a big number, but we often see divorce fees written off. Outside services, you're going to want to know why those are paid, the $60,000. You could get 1099s, see who they're paid to. Sometimes people might think they're paid to family members that don't work. And that's kind of all of those. So here, the cash contributions, there you go, $182. That's what the 12A was, the other deductions. That's also going to flow through to their personal tax return. So they'll get a slight deduction for that. So obviously the business paid $182. Actually, it's 60%, so it'd be 182 divided by 60. If anyone wants to do the math, be my guest. That would be the amount of the cash contributions that the corporation made. Small number like this, we don't worry. I've had them where they're hundreds of thousands or millions of dollars. Then we start to ask questions. Why do you need them? Is it necessary for the business? Things like that, because obviously it's disrupting cash flow.
All right. So I'll shoot over so Dave walked you through a Schedule K1 for
Sorry,
an
Lou, I'm
S-corp.
sorry. Can you go back for a second? Because we want to talk about the other assets also, just briefly.
Sure.
Down a little. Line 5 is the other assets. So you're going to want to look at what this one says, just other. Obviously, we're going to have a question on that. What that other is, why do they call it other? Don't know. And then if you move down a little, I don't think there were other, here's other liabilities, sales tax payable, things like that. So those are things you're going to want to, sometimes we see other current liabilities are loans to affiliates. So you're going to want to make sure if that's the case, those will tie out. So I just wanted to show that because there, we did show the statements on the balance sheet. Sorry, Lou, you're up.
Nope, no problem at all.
Just a quick time check, guys. We got about 10 minutes left.
Thank you very much. So I'll just go quickly through. Dave walked you through an 1120S Schedule K1 for an S corporation. This is a Schedule K1 that is for Form 1065 for a partnership or limited liability corporation. So I just want to go through some of the key differences. So first of all, on an 1120 SK1, there is no capital account. That information is tracked separately by the accountant if they maintain what's called an AAA account, but not necessarily always done, but certainly not explicit on the tax return. On a 1065 K1, that capital account balance is explicitly stated here. So this particular K1, it's a little pixelated. You can see that they started with $198,000 of capital account balance. That is specifically attributable to this member. Okay, so it doesn't necessarily have to be pro rata with their ownership interest. It's whatever this particular member has not taken distributions of. So here's an example of in this year, this member had $11,000 of income that was charged to their capital account, but they didn't take any distributions on that income. And as a result, their ending capital account balance was higher at the end of the year than the beginning of the year. So, we always seek to understand, the differences between the reported income and the distributions and why there were no distributions taken, not just for this particular year, but clearly there's a buildup of capital here. Um, Dave showed you the number of shares that are owned by the shareholder and how it results in the percentage of the business that they own. There aren't shares in a partnership or a limited liability company. They have membership ownership interests in this case. So this is unique. So there's only one percentage for the S corporations, what your ownership percentage is. In this particular, or for all 1065s, they present a profit percentage, a loss percentage, and a capital percentage. A lot of times, those percentages are all the same. But what they're essentially telling you are three things. What percentage of the profits is this member allocated? What percentage of the losses is this member allocated? And of the capital of the business, how much is allocable to this particular member? Now, the profit and loss is typically contractual. Again, it usually goes along with their ownership interest, but it's conceivable that somebody could own 50% of a business, but contractually only get 20% of the profits for whatever reason. It's just an example of a real life scenario that can exist.
Or in this case, they have 45% of the capital and get 50% of the profit and loss. So it could be the other way as well.
Exactly.
And by the way, we apologize. Those ending numbers are supposed to be identical at the beginning. Obviously, the whiteout issue somehow erased them.
Gotcha. Yeah, I was going to ask about that. Okay. So this should all be what,
50, 50, 45. Yes.
Okay. Now that makes a lot more sense. I was wondering why this person had 0% capital when they
But
have
had
a capital account balance.
120,000 capital.
Yeah,
That's
absolutely.
how I know.
The rest of it is fairly similar, except that instead of 16A for distributions on this K1, you're going to look for box 19, and it's not so difficult to find because it literally is labeled distributions. We talked about compensation of officers on an S corporation. On a 1065, instead of compensation to officers, you're going to have guaranteed payments to partners or members. So officers' compensation on an S corp, typically the mechanism is through a W-2. On the flip side, on a Form 1065, that guaranteed payment is going to be reported not on a W-2, but right on the K1 as a guaranteed payment. So in this case, this particular member had $655,000 of guaranteed payments. That was in addition to their pro rata share of the business income, which was $61,000.
Lou,
Yes.
go down back to the capital for a second. We often see, could keep going, like the ending capital is negative. Why don't you talk about what that means when we have negative capital?
It can mean a couple of things. So ending capital could mean that that particular member distributed or received distributions that were in excess of the income that was allocated to their capital account. Um, we do seek to understand what that means for the business. If upon a sale of the business, that member has to sort of true up their capital account and bring it back bring it back to a positive number where it should be. But also, it could be because of real estate holding entities. As an example, we mentioned earlier taking depreciation year over year. As a result, that usually reports in reported losses. So they're not cash flow losses, but they're reported income losses because they're taking that depreciation expense, which, as we mentioned, is not a real cash flow item, but that does cause the capital account to be negative.
Or the company could just have losses continuously or in excess of gains in the past, and that would cause it, could cause it as well.
Correct. And two last things to point out. Page 1 of the Form 1065 tax return is going to report those business activities. Remember, that was on page 2 of the 1120S tax return. And also on page 2 of the 1120S tax return was that accounting basis, that cash or accrual. Form 1065 reports that right on page 1 instead of on page 2. And those are really the two principal differences.
Lou, we've got one additional question about K1s in the chat. So before you move on to this, I just want to address that. Under a Schedule K1 Form 1065, specifically W-2 wages on a statement QBI pass-through entity reporting, is the amount listed for W-2 wages the income the business partner received for the year?
No, that's just their wages. The income would be added to that. So if Lou, you want to go to the bottom of this, go to the K1 again, I guess is probably the best way to show it. So here there's no, I would go to
Yeah,
the
this
K1
was,
for the S
there you
corp.
go.
Yeah.
Ye-
So you get your wages, and in addition to the wages, you have the ordinary business income. That would be your number. Now, again, on a 1065, you're going to get the guaranteed payment on a W-2. But if you look at an S corp, it's going to be ordinary business income allocable to that shareholder plus their W-2 wages. That's going to be their income, plus or minus any other things that may be on the K1. Okay. But their cash flow would be different because their cash flow wouldn't be the ordinary business income. It would be their wages plus their distributions. And then obviously, if there's perks and things, we'd have to take that into account.
Thank you.
No
All
pleasure.
right.
All right, everybody. Enjoy spring. Enjoy the tournaments. Thanks for joining us. Hope you got something out of it. And obviously, if you have any questions, feel free to give either Lou or myself a call. We will be distributing these slides to everybody as well. Thank you very much. Have a good day.
Have a great day, everybody.